the lie about risk to reward that's keeping you unprofitable. You're in one of two camps as a trader. Either you hold trades too long and watch them turn against you, or you close them too early and never let your winners grow. Both come from uncertainty and emotional decisions without structure. In this video, I'll show you exactly how I manage my trades, from profit targets to risk to reward to stop management, so every trade is planned before it even begins. Why you keep losing money on good trades. From my experience, many traders are chasing unrealistic profit targets because of people you've seen on Instagram. You want to be very mindful that you can trade 10R, 15R, 20R with the necessary experience and time frame alignment. But early on in your first year to 2 years of development, if you're trying to chase 5R, 10R, 15R and using unrealistic stop placement, trying to hold too long, it's a recipe for disaster, and you're going to make your trading a lot harder than it needs to be, as opposed to if you just looked for more realistic targets and then grew into being a bigger trader over time. Moving stops too soon, trying to protect profits. I see this all the time with traders I work with. You get an entry in here, market runs a little bit in your favor, and then you panic and you roll the stop to break even. A natural retracement stops you out and it goes exactly where you thought it was. This is very easily fixed. You just have to have conviction in the trade, and you have to be comfortable in the open risk. From my experience, many times, if you feel the need to always have to rush the stop to break even or always move it into profit, it's probably because you're not comfortable with the risk that you're trading. So you probably want to size down, because professional, consistent traders are comfortable holding the risk that they're in. And you can't always rush the stop loss being scared money, because as we covered in the last one, scared money is making no money. Taking partials emotionally and not mechanically. So you get into a trade, market retraces, you buy here, it runs a little bit, and then you close the trade because you're fearful that it's going to take away the little bit of profit that it gave you. This is going to skew your risk to reward, because now if you're closing out at 0.5R or not even 1R, now your losses are bigger than your winners. Huge problem from a money management standpoint, because our winners should be bigger than our losers, which is what allows us to take these small little paper cuts in terms of losing trades and be able to easily fix them. But if you're scared money and the market starts to run in your favor a little bit and you see a little bit of green and you panic and you think you need to take it all off the table, that's not going to give you the longevity you're looking for. And this is why you keep losing money on good trades that should be profitable. Results shift every week because the process changes for every trade. So if you're always changing your process for the trades you're taking, trading a new model here, a new entry there, or trading multiple models before you've mastered one, you're going to have a P&L that's very inconsistent. You might have some wins, but you're going to have a lot of losses that overshadow those wins, and you're either going to be a losing trader or a break-even trader. Good news is if you're a break-even trader, it's really easy to fix that with just a few changes. However, if you're constantly shifting your process and you're not mechanically doing the same things every single time, if your trades don't always look the same, you're going to have a lot of trouble with finding consistency long-term in your P&L. The truth about risk to reward: you don't need 10R to be profitable. Focus on a repeatable model, not casino victories. So many traders, when we come into this, right, we're excited by the idea, the prospect of being able to make huge money, and that's absolutely the case. You can make huge amounts of wealth in these markets over time, but it's not going to happen right away. Many come into these markets treating it like a casino. So they're trying to get huge, big windfall victories right away in the short term, instead of focusing on a repeatable model that's consistent. It repeats every week. Sure, it's going to have some losers, but there's more winners than losers because you've back tested it enough to know that. And now over time, the money management will do the heavy lifting. But if you're always trying to gamble and take big wins and have a low strike rate because you don't really know what you're doing and you don't have a repeatable model, you're not going to be successful, and you're going to have a roller coaster P&L. Consistency is much, much more important than lottery wins. Meaning, I would rather see a trader have a consistent model that, let's say they take 2 trades a week, they have a 50% strike rate, and within that, they're holding for 1 to 2 risk to reward. So that means they're taking 2 trades, they're winning 1, losing 1. The winner goes for 2R, the loser is stopped out at negative 1R. So now they're finishing each week plus 1R. It's not sexy by any means, it's only 50% strike rate, but they have a model, it's consistent, and over time, you can grow an equity curve really nicely with a consistent, repeatable model. And even 2 trades a week, 50% strike rate, many of you thinking, wow, I wouldn't want to trade like that. But guess what? It's making money. And what you're doing probably isn't. And these are things you want to start thinking about, because I'm trying to help you get into the winner's camp. Let your system compound results over time. Once you have a system like I just mentioned, it's easy to see long-term consistent results, but you have to let time do the heavy lifting. So anytime there's a little bit of drawdown or the market comes off the equity high, You have to be very mindful not to lose your mind. Just keep following the model. What does the process say to do? And over time, you can have a consistent P&L if you're having a consistent, repeatable system and you're letting money management do the work over time. Risk to reward is going to evolve with your experience. So taking partials depends on your level of experience. So how long you're going to hold a trade for depends on how long you've been doing this and how confident you are in your targets, how good you are at reading institutional order flow, and how much conviction you have in your top-down analysis. And the better you get at all those things, the more you're going to be able to hold 1 to 4, 1 to 5 type trades. But in the beginning, you want to focus on easy base hits. 1R, 2R, maybe 3R, and be consistent with that. Be content with that. And then what you're going to want to do is keep studying the trade like you're still in it. So if you're, for example, going long here, and then you're closing out at 1R because you're in your first 6 months or your first year of being a profitable trader, it's going to be really stressful to hold it for 2 risk to reward multiples or even 3 risk to reward multiples. So what you're going to want to do is close at 1R and then study the trade as if you're still in it, and then watch it run to your next target and then your next target. And then what that's going to do is build your confidence over time and then allow you to grow into that 1 to 3, 1 to 4, 1 to 5R trader. And that's exactly what I do with those I work with. Because if you're trying to shoot for the moon right away and always hold for 3R, 4R in your first year, it's a recipe for disaster. And it's not going to give you the longevity you want. One of the sayings that I use for holding into bigger trades is it's kind of like a splits, right? If I try to drop down into a splits right now, I'm probably going to break some. But if I stretch a little bit and then a little bit more tomorrow, then a little bit more the next week, in a few weeks, I could probably drop down into a full split. It's the same thing with bigger trades. You're not going to hold for 1 to 3, 1 to 4 because it's be very uncomfortable. But over time, as you get more confident and you stretch a little bit more and then you hold a little bit longer, then you hold a little bit longer, you're going to have more confidence to let the trade run in your favor as you get more experienced. If you're new, my recommendation is to focus on 1 to 1 or 1 to 2 and build the consistency first. If anyone tells you you can't be profitable with 1 to 1, 1 to 2, they're a joker. I got profitable with 1 to 1. I was trading the S&P. I was only looking for 5 handles in profit, 5 handles of risk, 1 to 1. Once I got that for the week, I was done. And that's how I initially started to get profitable and consistent. And then from there, it obviously scales well beyond that because then 1 contract turns to 2, right? And then 2 contracts can turn to 3. And then now instead of 5 handles, you can let it run 10 handles, right? And you can see how you can scale it over time. But if you're not even consistent with 1 to 1 or 1 to 2, you're never going to be consistent with 1 to 3, 1 to 4. Over time, target 1 to 3 and 1 to 5 with confidence because you're doing what I'm talking about here. You're not going to try to hold for 1 to 5 in your first month of profitable trading. After 6 months to a year of consistent trading, now you can start to look for bigger targets, 1 to 3, 1 to 4, 1 to 5, because you have the necessary experience to manage it and let the trade go. Holding RR requires data and experience. So you need to have data, you need to have stats that you can look at over time of backtesting, collecting these logs and seeing, okay, well, from my entry, the market does run 1 to 2, 1 to 3, even 1 to 4. So now over time of collecting that data and the experience factor, which needs to build, which is very important, you're then going to be able to hold for larger risk to reward as you prove it to yourself that you can do it. All right, so now for profit-taking levels. You want to use PD arrays to define scaling points, and you want to pay yourself at logical levels. So let's say that you're trading the one setup for life, 930 opens here, we sink into an old low, and you're looking for the market to rally. You get an entry here because, again, we're predicting the move. We're not reacting to it. We're not chasing the market like retail Rick. We're predicting where it's going to go. So we see the market drops, hits your entry, the market rallies. We have a fair value gap here and a buy-side liquidity pool. You want to start scaling out at logical levels that make sense because that's where the market may turn and not get to your best case target. Take profit at key imbalances or liquidity levels. So if you don't understand all the PD arrays, that's fine. I can't cover all that here. That's very detailed subject matter. However, liquidity and imbalances is more than enough to start. So if you're long down here, and then you see on this drop that set up the rally that we're looking for, you see imbalances and you see old highs. Those are levels that you can take partials at because the market may just go up to those levels and reverse and not give you that best case target. So you always want to make sure you're scaling out at levels that make sense. And you can always keep a portion running if the order flow supports continuation. So in this example here, if you're really bullish and let's say the market's leaving a lot of breakaway gaps, there's daily levels above that the market's likely going to draw into based off your top-down analysis, then you can let runners go. But you have to understand how to read order flow. And again, that's going to go back to what we just talked about, the experience level that you're at. Don't force best case targets, follow the model. Perfect example here. You go long, you say, okay, well, I need to have 3R to make back all my losses from this week, right? You get long, you hold for this target, you were in a great trade, right? It gave you profit here, gave you profit here, but then you held the bag too long and it came back on you and stopped you out at break even or at a loss. That's easily fixed by scaling out at levels that make sense, meaning this imbalance here, as we trade into that, scale something off. As we run into this buy side here, scale something off. And then over time with experience, you'll know when you don't need to scale something off here and when you don't need to scale something off here and you can let it keep running. But when you're developing, you want to take partials. All right, so now getting into stop management. You want to let the stop breathe. Don't rush to move your stop to break even, because this is exactly what happens. You get a good entry here. Market starts running in your favor. You say, wow, this is great. Let me put stop to break even. Natural retracement happens, bumps you out of the trade, and runs to your target. That's easily fixed by simply leaving the stop where you had it. Don't be in a rush to move it to break even. Don't be in a rush to move it into profit. Let the trade play out. You put the risk on the table. You've done the back testing. You've studied the model. Trust it. Let the market do its thing, and trust in your money management. Because if this trade doesn't work out, it shouldn't end you if you have solid money management. You have to give the market space to operate, right? So this is what you want it to look like. If this is your entry here, and this is where your stop placement is, don't get all excited when the market starts running in your favor and think it needs to go to break even. Just leave it there. And then once the market starts to run, if it does retrace, you still have given the market plenty of room to breathe, and then you'll see your targets realized even on these retracements. Only adjust your stops because your rules say you should. So you want to have a rule-based stop, meaning all your trades should look the same. Your entry should look the same. Your stop placement should look the same because you have a trading plan. You have a system that you're following. If you don't have that, you will not be profitable. You have to have a consistent way of going into these markets, entering, placing your stop loss, taking profit, and it needs to be repeatable and it needs to be boring. So if you're entering here and your stop goes there, you have a rule-based stop. So you leave it there. And then whatever your rules say to do, that's what you're going to follow. Don't move the stop until you've banked a partial at 1R. I recommend, if you're taking an entry here and the market gives you 1R and you're a newer trader in your first year of trading, there's nothing wrong with taking something off here. Then and only then would I recommend moving the stop to break even. I don't think you should let green trades turn red after you've already taken partials. So what I recommend is if you take that partial, at least at 1R, right? Because in my opinion, if you're trying to take profit at less than 1R, you're skewing your risk reward, and now you're having bigger losers than winners. And that's the opposite of what we're trying to do with good money management. So my recommendation is if you take partials at 1R, then roll the stop to break even. Because then if it comes back and stops you out, who cares? You're paid. And then if it runs, you can take a reentry, or if you're new, just leave it alone. Take the next one. And then if you do take a partial and it keeps running, then you still have something to go to those best case targets. So that's how I recommend to manage it, because it's a win-win situation. Like there's no way you can lose. If you get paid and it comes back and stops you out, that's fine. You got money in the bank. If it keeps running with 50%, 25% of the position, whatever you decide, even better. All right, now let's get into some real-time examples here. So we have our 930 open. We have our buy side. We have our sell side. We have a feeling that the market's going to want to use these equal lows, but we have to wait for the market to do what? Raid the buy side first for this model. So we see the market trades higher at 930. We clear the buy side. Now we have the opportunity for a trade setup to form to the downside using the one setup for life. Playing this forward, we now want to see a breakdown here in price. And now here's how we can trade this. We have the 3 up close candles. That can be a bearish order block. So your risk reward would look like this. You would short here inside the opening price. Stop loss could go above this fair value gap here. And then you would aim for these lows down here for a nice 1 to 3 risk reward. Now for the stop placement, what I would do is as the market starts to give you feedback that it's bullish, we want to see it start to break down. And then now we get below this inversion fair value gap here. So now what you can do is remove risk off the trade because it's running in your favor and it's already delivered 1R. So you can pay yourself here in a discount of this range from this low to this high. We have equilibrium here. You can pay yourself in a discount and then roll the stop to break even and then see if it gives you the rest of the run into the sell side. Now here we have an up close candle. So if you're going to trail the stop and you want to be aggressive about it, now you can trail the stop all the way down to here because you wouldn't want to see this up close candle traded through. Remember what we covered in bearish institutional order flow. Stop placement becomes so easy. Entries, stop placement, take profits becomes so easy once you learn how to read price. That's why the first thing you have to do as a trader, if you're looking to get profitable, is don't worry about the entry. Don't worry about the profit targets. Don't worry about where's the market going next. Learn how to read price action because once you can do that, stop placement, managing the stop, trailing it becomes so easy once you learn how to read the candlesticks. So now the stop loss that was roll down to here, can now be dropped down to this up close candle now. And what that does is it locks in profit. So maybe you already have a partial here, and now you have your stop rolled into profit. So if it does take you out, if you're bearish, do you want to see up close candles traded through? Not if you studied and you watched our last video, because you don't want to see that at all. You want to see it hit it and start to break lower. Then here we would see the market drops down in the sell side here, and that would realize all these targets here. Now, let's say you used the inversion fair value gap here as your entry. Right, so let's say you didn't get the order block, it just dropped too fast for you, and then we close below this inversion fair value gap here, right? Because it was used as support when the market is bullish. So when it's bearish, it'll be used as the opposite, and it'll be used as a inversion fair value gap. So we close below it, we hit it here, so you can have a entry that would be here at the low of this candle, and then you could just have your stop above the high of the fair value gap, and that would be your 1 to 2. So you could take an entry here. As the market starts to break down, same procedures. You can drop the stop above this up close candle here, trusting that it should not violate that. And again, that comes from understanding institutional order flow. And you can pay yourself at 1R, 2R, and that's how I would manage the trade here. This is exactly what you want to see. Imbalances either respected or left open, even better. And every up close candle or inversion fair value gap should act as resistance. So the levels that I taught you guys in the last one for entries can also be used for reading order flow. So maybe I'm not using this inversion fair value gap as an entry because I entered short up here. But what I will use it for is I want to see it trade up into it and repel price lower. I may not use this up close candle here as a bearish order block, right? I may not short that level here. But what I will do is I'll use this level for insight that the market should repel lower and turn from here. So just having a well-rounded understanding of price action is, again, going to help you with your entries, your trade management, and you're not going to be stressed out. Because instead of worrying about the P&L and just watching that fluctuate up and down, you're actually going to be watching the candles and the institutional order flow and letting it tell you what it's going to do. All right, so same procedure here as every day. We get to the 9:30 open. We frame our sell side, frame our buy side. We want to see who they put on the hook first. We see the market opens. It drops first into sell side. Get that back down through here. So we see the market drops, sell side taken. Now, what do we have above? We have these relatively equal highs here. We have this high here. And we're going to expect the market to want to draw higher up into those levels. So now we want to look for our entry. We see the market has already taken out the lows. We've initially rallied higher. And now we have the market rally closing above this up close candle here. So we've now gotten above that on a closing basis. So what you can do is you can buy this as a bullish order block here, if that's your model. So if the bullish order block makes sense for you as a long, this could be your entry here. Stop at the low and then target the highs here. That would be entry number 1. How I would manage it if I use this entry. So you're taking the entry here, either as it's leaving that range or if it comes back down and touches it. As I taught in the last one, sometimes it won't come back down and touch the order block. So I'll buy as it's leaving that range. The other thing you could also use as your entry as an additional confluence is this inversion fair value gap here, right? Because if the market's going to be bullish and it's going to run higher into these highs here, then it goes without being said that this gap here is not going to be a sell-off. It's going to be an inversion fair value gap. So you see inversion fair value gap here. So you could even buy inside this range as well and still have it be a good entry. So let's say we'll use the best of both worlds. We use the order block and the inversion fair value gap. Here we see the market runs. This could be a scale off level here. This would be at just about 1 to 1. So for developing traders, there's nothing wrong with getting in here and getting out. You may say, well, Dylan, that's not sexy. I can't take that to social media. That's not the point. You're here to make money. You're here to get a better life for yourself and your family. And 1 to 1 absolutely does that. And then over time, you're going to see, okay, well, there's equal highs here. So I'll see if it can keep running. And now you can try to get the 1 to 2R. And then you'd see what that looks like. Market retraces into the gap here. Nothing to panic because this gap should support price if we're going to be bullish. So now if you've already taken a partial here at this high, what I would do is I'd roll the stop to break even. Because now if it comes all the way back down through this high and trades through this fair value gap here. Let's change that here. It's not an inversion gap. You don't want to see it trade down through this gap. So now you can roll the stop to break even. You've already banked a partial. And now you've got a runner going to the high here. So now it's risk-free as long as the market stays above this fair value gap here. So we'll take off the risk to reward tool. We see the market comes back down into that gap again, which is why you can't be in a hurry to always rush the stop loss higher. If you entered here, leave it down here if you're trying to hold for bigger runs. Again, that's why it's an experience thing, because you may see this happening as you're long and see this drop down into here and start freaking out. That's why when you're first starting, it's natural to feel like that. That's why you want to scale off at levels that make sense. And then over time, as you get more experience, you'll see, okay, it's just diving down into the gap, accumulating the stops here, but it's still staying in the upper half of that gap with the bodies. So we see the bodies are still staying in the upper half. I see that. My experience tells me everything's still bullish. This was just a stop hunt, and we did not get below that fair value gap, and that the market's going to keep careening on into the buy side here. Now, in terms of runners, if you took let's say we use the inversion fair value gap entry, stop here, you paid yourself at 2-to-1, you can let runners go. So we're not expecting the market just to hit this high and sell off, because we're not support and resistance. So let's say you have levels above market price that the market's likely to draw to. Like let's say maybe you have now these relatively equal highs, and then what do we have above these relatively equal highs here? My eye jumps to this imbalance here. So we have a large imbalance here that formed from the overnight session. And then we could let runners go to best case targets while we're already paying ourselves. So we're already paid potentially here, definitely here. Definitely at these equal highs at 1 to 2R, you should definitely have something off for this model. And then from here, we'll see if you can get the continuation into the best case target, which it does. And this is how you can go about leaving runners. Now, why would you leave runners? Well, everything is bullish as it relates to the institutional order flow, right? We have imbalances supporting price. Down close candle here. Yes, it traded through it. The only rule is down close candles can be violated if it's going to sweep the stops. So the only time you'll ever see a down close candle violated when you're bullish is for the market to drop, clear the stops, but then it should give you immediate feedback that it's bullish. It should immediately start running higher after it takes out these stops here. And then we see what every imbalance, small little inefficiency here, hits that, and down close candle, rally supports. We see breakaway gap here, everything telling you that the market is extremely bullish and you can let runners go into these highs here. So that's how I'd go about taking my entries, placing the stop loss, managing the stop, taking partials, using the one setup for life in these real-time examples. So structure is going to remove the emotion for you. You've learned a lot in this series up to this point, and now the only thing that's going to hold you back is if you don't add structure and discipline to your trading. Emotional trading comes from uncertainty. Uncertainty in your trading plan, uncertainty in your model, uncertainty in your targets, uncertainty in your ability to read price. And if you have uncertainty in all those areas, you're going to have emotional trading, which again looks like those roller coaster P&Ls that's just up and down and wild, like we just saw in the previous examples. Structure eliminates the second guessing. And when you have structured execution, you're going to have a smooth equity curve that's going to reflect that structured execution. Now, what do I mean by structure? Structure means you know exactly what you're looking for when you sit down to trade, meaning you have a routine. If you're trading the one setup for life, this is exactly how I teach those I work with to do it. Get to your desk 20 to 30 minutes early, have everything ready in terms of your top-down analysis, your key levels, what you're looking for, and you have your trading plan printed out next to you. Everybody that works with me has a one-page simple trading plan. They have it printed out next to them, and they're making sure they're following it every single day. So now you're sitting down, you're at your desk early, you have your analysis, you have everything ready to go, you know what you're looking for, you can already read price at a high level because you've studied, and now you have your trading plan. You have your piece of paper next to you that's going to tell you exactly what you need to do. And as long as you stay in those rules and you execute with the rules that you've created for yourself in your trading plan, trading can become so easy. But you need the structure, because without that structure, without knowing how you're going to size, right? What position size do you use? What are you using for your entry? What needs to happen before you even take an entry? What's your model? What's your money management? What do you do after you take a loss? If you don't have those things defined in a simple trading plan, you're never going to find consistency. And if there's one thing you take away from this video, I hope it's that. Because if you're going to make a real change in your trading, not just see this model and say, wow, that's cool, it forms every day, I want you to make money with this. But the only thing that's going to allow you to be profitable and make money is if you dial the fuck in and you have a trading plan. You learn how to read price at a high level. You study your model, you backtest. This is a lot of work. You're running a business here. And if you're going to be running a business, it's going to require focus, organization, and discipline. Over time, discipline and consistent money management will allow you to scale. Because now the next thing is, well, Dylan, with 1-to-1 R, I can't be a millionaire. Well, you can. But if you want to scale to bigger trades, bigger leverage, that's only going to happen over time with discipline and with consistent money management. Because without those things, there's no foundation. And you can't scale something, you can't build a skyscraper with no foundation. Because if you try to build it, what's going to happen? It's just going to come crashing down every single time, and then we're going back and giving our monthly donation to Apex or whatever funded company you're trading. And I don't want that to be the case for you going forward. It's very simple, but it's not easy to do in the moment. But all you have to do is add structure, add discipline, and over time, you will be able to scale your trading. You will be able to trade multiple accounts. You will be able to hold for big runners, but it's just going to take time and focus. So in summary, trade management in one sentence: plan everything before the trade begins. Before I take an entry, before those that work with me take an entry, they know where they're getting in, they know where their stop loss is, they know exactly where they're going to take profit, and they know exactly how they're going to manage the trade. Follow your model, not your emotions. Again, if you don't have a one-page trading plan next to you, book a call with me, we'll speak, and I'll help you get that sorted out. But you want to follow your model, not your emotions, because once you have a model, you have a trading plan, it's so easy to stay consistent, and then emotional decision-making won't take over while you're trading. Pay yourself at logical levels. So whenever the market gets to 1R, 2R, especially as a newer trader, make sure you're getting paid there. As you get more experience, you can let the dogs run, as I say, and you can hold for bigger targets, but it's just going to take experience to do that. Let your stop breathe and trust the rules. Don't rush your stop to break even. Don't rush it in profit. And just trust your rules, trust your plan, right? Trust in the process that you've been studying your ass off to work for. Consistency in your execution is the only way you will ever see consistent results. So the only way you're going to see longevity is if you have consistent execution, meaning, as we already said, your trades look the same, your stop management is the same, your take profits are the same. And then once you have that consistency, you're going to see it reflected in your equity curve. In summary, I'm going to leave you guys off with this. When I'm working with a trader, the biggest thing that we're focused on is the discipline, the consistency, and the following of the trading plan. Because when you focus on the skills of trading, the money is effortless. So if you focus on the process, not the profits come in faster by focusing on the process. Hope this one was insightful. See you guys in the next one.